Investors Chronicle.
It's the Investors Chronicle Companies and Markets show. It's Thursday, the 27th of June as we record. Welcome to our latest episode. I'm Dan Jones, and on today's show we're looking at a trio of very different companies and their respective full-year figures. First up, we have luxury watch retailer Watches of Switzerland, which had a nightmarish start to 2024 but has since found its footing somewhat. Chris Akers is with us to talk through the figures and the company's prospects. Then we'll look at cable and component manufacturer Volex, one of the leading lights of the AIM index. Jemma Slingo is here to discuss its diversification strategy and its dependence or otherwise on the likes of EVs and consumer electricals. And we will wrap up with a company whose shares are up 200% this year, having more than halved in 2023. That's CMC Markets. Mark Robinson will run the rule over the trading platform later in the show. Watches to begin with, though. Chris, welcome to the show. I know you've been looking at these figures which came out this morning as we record, as I say. How do they strike you? Things seem to be improving a bit after all the profit warnings we saw at the beginning of the year and last year.
So the results were really as expected after a pretty tough year for the company. Revenue came in flat and adjusted operating profits were down 18%. So there were some pretty big price increases in the year, and that's down to the strength of the Swiss franc and also some cost inflation. And when you combine that with the weaker consumer confidence we've been seeing after the sort of pandemic luxury spending boom, it's no surprise that we've had a weaker performance. But there were some encouraging signs in the results, which is why the share price is up more than 10% this morning. Management spoke of some stabilization in the UK market after revenue and profits fell there in the year. And the US performance continues to improve. US revenue and profit were up by 5% and 6% respectively. And importantly, management stuck with guidance for 2025 and also reiterated its target of more than doubling revenue and profits between 2023 and 2028. So some promising signs despite a very tough couple of years.
Yeah, the underlying issue is the fact that the luxury watch market, well, one of the underlying issues, we'll come to the other one in a minute, still seems to be in a cyclical downturn. Is that fair to say? When you look at recent figures compared with a couple of years ago, things are not as good as they were. Are we getting any more signs from these results as to how that's shaping up in future, whether this is going to persist for a long time or a temporary period or what have you?
Yeah, I think it's fair to say the market is still in a cyclical downturn. So exports of Swiss watches have been on a downward trend in volume terms after growing in 2022 and 2023. And that's despite some recent good news on export values. So it's undoubtedly a very difficult time for the market in the aftermath of that pandemic boom with higher interest rates and weaker consumer confidence, as I mentioned. It's difficult to say what's going to happen in terms of exports and prices, etc., over the next year or two. But the company had a pretty interesting comment on the market environment in its results today. It said that the industry as a whole is being more conservative on production, which we believe is a responsible approach to the long-term stability of the luxury watch market. I think it's fair to say some pretty serious short-term headwinds, but things could be looking a bit better in a year or two.
Yeah. The other big issue which has been hanging over the shares for a few months now is Rolex, which obviously provides a lot of watches to Watches of Switzerland. It bought a business a few months ago, and that suggested that it was going to effectively start distributing more watches itself. That obviously would have implications for Watches of Switzerland. Both companies have said there's no intention of this happening. Watches of Switzerland is a big distributor for Rolex. What did we learn today, maybe in recent weeks, months as well, about how that's going? Because one of the problems in January, I believe, they discussed on the earnings call in January was that Watches of Switzerland were getting fewer watches or fewer of the very top-end Rolexes through. They were getting, I think, more stainless steel than gold, which apparently is not quite as good. things maybe have settled down a bit now, and there's certainly still no sign of that distribution agreement breaking down. But how do you read it at the moment, Chris?
Yeah, so the background to this is when Rolex bought Bushwear last summer, this raised fears, as you say, that Rolex could set up its own retail network, which would be a pretty big threat to watches in Switzerland. But I think looking at this as a whole, I think the market has been too negative about potential implications from this. There wasn't any sort of comment on this today so far from the company, but I think the market is being too negative. As RBC points out in its note today, the company remains a key partner for Rolex with around a 10% global market share. But yeah, while there was no comment on Bushwear or the issues you mentioned, there was fairly positive comment on Rolex supply, which was interesting. This is to do with the Rolex certified pre-owned program, which the company launched in the year. It's performing ahead of expectations in both the US and the UK. And the company said it's set for further rollouts in the new year with what it referred to as improved methods of supply in the UK market. So nothing really to add on the Rolex Bushwear issue. It's still obviously a pretty big threat to the company, but we haven't learned anything else today. And as I say, I think the market has been too negative.
Chris, you alluded to the pre-owned strand of the business now. That's been growing quite quickly. Does this point to the fact that the investment angle is becoming more important in terms of watch sales as well? Because it seems to me the fact that, as Dan mentioned before, if they're only getting second-tier Rolex through to Watches of Switzerland now, does that indicate that at that top level there, it's the investment angle as much as the consumer angle that's driving those sales?
Yeah. I think that's completely accurate, Mark. I think from what we saw in the results today, that completely bears that out. And I think that's something to watch for investors moving forwards as we go ahead this year.
Yeah, it does seem the CPO program is doing pretty well, particularly in the US. I mean, I couldn't tell you, not owning a watch, what the pre-owned prices are versus the new, but I imagine they're all pretty elevated. I think with the top-end products, that was a supply constraint back in January rather than a permanent thing, but it was more the context of whether the supply constraint for the very top end would continue and whether it was deliberate. It doesn't seem that way so far. And as you say, Chris, with the supply coming through from Rolex, I think the optimists or the bulls would say that Rolex actually wants to boost supply everywhere. So even if its own network does take off, it's still going to be pushing more out through the likes of Watches of Switzerland as well. So there's some strength there potentially. Can we talk a bit more about what else the company's doing to help itself through this, as we say, cyclical downturn? It's made an acquisition of a jewelry business relatively recently, I think, Chris, which is still pretty small beer, but diversifying a little bit. There's the pre-owned program, as we just discussed. It's still looking to expand in terms of number of stores, so it's not hunkering down. How do you see the expansion prospects, whether it be physical stores or things it's doing in the business?
Yeah, so it's doing various things, as you mentioned, Dan. So it's opening and acquiring new showrooms in both the UK and the US. It made that US acquisition after the year ends, a jewelry distributor called Roberto Coin. Pretty small, as you say. It's about $130 million acquisition, but that will help the company with sort of further inroads in the US jewelry market. Another thing it's doing, returns in Europe are weaker than in the UK and the US. So the company is actively reallocating investment to the US and UK, which sort of makes strategic and financial sense. And as we mentioned, CPO is performing pretty well. So I think prospects are strong on a longer term view. We have discussed some of the headwinds that have hit the shares over the last couple of years, the Rolex issue and the profit warning in January. But I think taken as a whole, this is a pretty resilient set of results and some positive signs for investors.
And you've got some supportive trends as well economically, haven't you? In the UK, there's discretionary spending trends are ticking up, which would obviously be helpful. And the valuation as well, given how it's fallen over the past 18 months, is perhaps as today exemplifies really when you get fairly decent results, there is room for the shares to rise, as we saw this morning. So as you've been implying, Chris, I think you are still quite optimistic on it from a valuation perspective.
Yeah, that's right. I think it's very important that the company stuck to its long-term targets and also its guidance for 2025. It got some nice revenue growth forecasts. And yeah, on the valuation, the shares are trading at about 9 times forward consensus earnings, which I think is very undemanding. The company referred today to having its strongest ever pipeline of committed Rolex and other key brand projects. And I think when you combine that with long-term growth prospects and that valuation, we think there was a sort of recovery story here get into, and that's sort of why I stuck with the buy call.
Yeah, makes sense. Okay, well, we're going to move from Rolex to Volex now. Jemma, you've been looking at the company, which is altogether more complicated, a lot of strands to the business. So why don't we go through the full-year figures and also sort of discuss what the company does, because it has quite a long history. It's been around for about 100 years or so. And in recent years, it's been expanding into newer areas too. What can you tell us about them?
So it's a bit less glamorous than Rolex, I would say, but basically it's traded on AIM and it's a specialist manufacturer. And without boring listeners with all the details, it makes cables, plugs, things that hold cables together. So sort of the bits of machinery that you don't usually think about, but which are crucial to making things work. And in recent years, it's been expanding. So it has customers in the electric vehicle market, consumer electricals, medical sphere. So it's got a nice range of customers, which is really paying off at the moment, I think. But yeah, if you think Volex, think cables, essentially.
And the figures themselves, how did the full year numbers look? Because it's been doing fairly well in a difficult market recently.
It has. So I think if you look at it as a whole, it looks strong. So organic revenue across the group was up by 7%. Statutory operating profit was up by 19% at about $64 million. So from a broad brush perspective, it looks pretty good. But shares did fall immediately after the results were published. And I think that was because there were some quite big discrepancies between the different divisions. So one of the big growth drivers for Volex used to be in electric vehicles, and that was seeing sort of massive double-digit gains year on year, and that has completely reversed now. So there was a 10% decline in organic revenue in the EV section, and consumer electricals are also under similar pressure, and organic sales were down by about 8% there. So it seems that investors were a little bit worried about those trends.
Yeah, the destocking trend, which was a similar story at the half-year results last year. To what extent are we getting through those? And on the other hand, what are the divisions that are actually doing quite well? Because there's some interesting aspects to those sides of the business too.
Yeah, so I was speaking to the management team yesterday morning about this, and they seemed relatively upbeat. So in the results themselves, they said they were seeing some signs of recovery in the second half of the year. And the CFO mentioned to me that on the consumer electrical side, in the final quarter, sales were flat year on year. So he saw that as quite a positive indicator that, we've been through the worst and maybe things will start ticking up. But I think the really interesting part of Volex relates to its sort of data center bit. So it calls it complex industrial, the division, and it basically serves cables to these high-speed data centers, and there's huge amounts of demand there. So that's been fueling growth. And also, I think there'd been a lot of hold-ups in the medical world around sort of component manufacturing, and those supply chains have now eased a lot, which was sort of pumping up sales in that division. So I don't know, there wasn't a lot of consistency in the results yesterday, I would say.
But in some ways that provides its strength, this diversification.
Exactly.
The AI, clearly, data center aspect is the kind of thing that nowadays attracts a lot of attention and is interesting. It's the kind of business where if they were solely in that business, you can imagine the share price having really gone gangbusters in recent months. And it kind of brings to mind as well when Volex at the turn of the century was really into telecoms cabling and really saw its share price soar and then slump on the back of telecom struggles. It is a much more diversified business now, though, as we've been saying. What about looking at its performance in the context of other peers? I mean, this seems to have been a particular strength it's had over the past year or so. The shares have done relatively well at a time when lots of other manufacturers have really found those destocking trends to be too strong to resist effectively.
I wonder if it's partly because it was starting from a lower base, because 6 years ago or so, it was dealing with falling sales, operating losses, investor sentiment was pretty sour. And it also had a very concentrated client base. So when it lost one of those customers a few years ago, things went to pot. So I think because the market wasn't keen on it, it had a long way to climb. And basically, as you say, it's been diversifying its work. It's also been building its margins steadily over time and focusing more on specialist products, so they can basically charge more for what they're selling, and there's less scope for a rival just to swoop in and make exactly the same product for a lower price. So it seems there's been this recovery story in the fundamentals of the business, which has managed to offset some of the pressures in its end markets and generally in the specialist manufacturing world of, the destocking.
Let's talk about some of those changes, because it has made quite a lot of acquisitions as well. It's quite an acquisitive business. It's investing in production still around the world, so there's still a decent amount of capex there. But return on capital over the past few years has been quite impressive too, which has been a big part of the recovery story in the shares, the sort of the transformation of the business. It's proven that it can do these things effectively and make money from them.
It has, and I think that will put a lot of investors' minds at rest, because in these latest set of results, the company was basically saying that they were going to be stepping up capital expenditure, moving production facilities around, sort of expanding production facilities. So there would be this heavy pressure on cash flow, it sounded like. And if you were looking at a company that historically hadn't done those sorts of things very well, you might be thinking this might be a disaster. But I think the track record it's established in the last 5 or 6 years is comforting from that perspective, because it's shown it has been able to follow its clients around the world and provide the services it needs and generate good investor returns.
That global reach is spread out pretty well, isn't it? It's not too imbalanced. I think it's got about 40% of sales in the US, another 40% in Europe, and 20% in Asia. So that seems like instinctively quite a nice mix there. What about the valuation? How does that look? There was a bit of concern, as you said, on the results in terms of the EV, the consumer electrical side, which are still big parts of the business. How do you see the prospects for the company relative to its value at the moment?
I think it's a useful company to look at in the context of others. So it trades on a forward price to earnings ratio of just under 11. And in isolation, that's not that helpful. But when you look at some of the other players in that space, it does look pretty cheap. So on the one hand, you have the massive companies like Halma, which trade on almost 30 times forward earnings. But in some ways, that's not that useful, because obviously it's a completely different kettle of fish. But further down the market cap spectrum, you have companies like Spectrus and even XP Power, which also makes power cords, which are still trading on higher multiples. And XP Power in particular has been having a very torrid time recently, but still seems to attract, higher multiples. So there does seem to be still a little bit of resistance to Volex in the market, I think, and I would say further to climb from a share price perspective.
I did see the other day RBC again. We were talking about them earlier, but they had it on a list of potential takeover candidates in the electricals small cap space. This was based on I think March valuation, so the valuation has risen about 10% since then. But based on what seems like a fairly decent PE ratio, EV, EBITDA as well, not too pricey. So clearly some people think there's more to come there, and you're one of them as well. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. We're going to finish, though, on CMC Markets, Mark, the trading platform. Now, this really has been a volatile business over the past few years. The momentum is very much with it at the moment. Let's go back to the results first of all. They were out a week ago today. What did you make of them? What did we learn from them?
Well, the metrics themselves were broadly positive. As you mentioned before, that's coming off the back of a fairly negative trading period as well. So revenues were up by about 11% over the period, and the net operating income hit a sort of a post-pandemic high, as they put it. In a sense, it's hardly surprising that the stock itself will oscillate, because there's a direct correlation with volatility in securities markets and its performance as well. It's the business itself has obviously expanded, and it's not simply an intermediary in markets anymore. I think that was the main thrust of the announcement itself, rather than the financials. I mean, the classic image of the day trader sweating in a single room with a revolver by his side is no more. They're pushing that business with a focus really on the institutional backers. So yeah, I mean, it was positive within itself, but it always needs to be seen in context with the wider market. The strange thing, though, I think they had at least two profit warnings, I think, last year. And as I say, the link with volatility is important because the VIX throughout most of last year wasn't particularly erratic. And that's continued into this year as well, with a possible exception of bond markets from time to time, and some commodity markets as well have been a little bit volatile. But the conditions aren't wholly favourable for CMC at the present time. So I think when we look at the results, we need to look at it in a wider context of where the company itself is headed.
Well, what has helped this year, I think February was when the fire was really lit under the shares to begin with, and that was the announcement of some pretty hefty efficiency measures being taken. Then in March, there was an unscheduled update that was very positive as well, more on the growth side. So what is it doing in future? What's it looking at? And can we also talk about this tie-up with Revolut that it announced in the latest results?
Yeah, I think that tie-up itself is a reflection of the fact that it wants to broaden its offering and actually create more collaborative arrangements with fintech stocks as well, where it's either going to be growth in the market, and it will change its focus slightly as well. The focus now is on further diversification into B2B technology, for instance, and also there's more of a focus on institutional clients as well, which is kind of interesting because typically they'd be lower margin. But when we think about the use of CFDs, really, the trading element, the private trading element, is minuscule compared to their use within corporate hedging arrangements as well. And obviously, it's a much bigger addressable market. And I think, CMC have always been aware of this, but I think long term, they're looking to embed themselves even further within that area. I mean, it's got plenty of competition in that regard. And I don't know off the top of my head what the global hedging market is worth, but it would be pushing trillions, I would imagine. So, yeah, that's where they're trying to head at the moment. There's also been significant geographical expansion too. So it's broadening not only its available product offering, but also the markets that it serves too. So that seems to be the underlying thrust of the announcement itself. I think it's a realization as well, is that the business is probably going to be in a little bit of a different space 5-10 years from now too, and it will need to sort of evolve and adapt to changing circumstances in the market. I mean, when you think about it, it's you're looking across a range of asset classes as well, the options market and mutual funds, SIPs, and also crypto as well. There's one example that might expand rapidly in the years to come. It will certainly change. The crypto markets will certainly change. And I think CMC is putting itself in a position where it can adapt to that.
Yeah, it's an interesting one, as you were talking about there, that it's trying to market itself as not just using its own technology, its API ecosystem, as it says, but selling it to others like Revolut, which is what it's doing. In some ways, reminds me a bit of Ocado in that it's quite a volatile share, and it's trying to say, look, we can actually, one thing we can do is actually sell our own tech to other people. The analogy breaks down in so far as CMC Markets is much more profitable and, as you'd expect from a trading platform, pretty high margin business, unlike grocery retailing online, on which the jury is still out. But yeah, clearly it's trying to move beyond being just a platform itself. What do you think about the valuation, as I've ended all three segments by asking? Because given the volatility in the shares, how do you see the prospects at the moment?
Yeah, it's difficult to know how an investor should approach the stock, really. They certainly need to be mindful about the underlying correlation with market volatility. I did notice, well, that the consensus rating, the forward consensus rating, has crept up over the last few months as well, but it doesn't seem particularly expensive on that basis. And I looked at the PEG ratio. And judging by, I mean, you should never just judge these things in isolation, but looking at that, it appears that the market hasn't priced in all the prospective growth for the stock as well. So it might be worth a second look. The general outlook for the stock, or the market outlook for the stock at the moment, isn't wholly favourable. So on that basis alone, it's worth a second look, I think.
Yeah, and it depends, as you say, doesn't it, on what kind of business it is and how you characterize it. You look at people like plus 500, things like that, their valuation on the CMC is ahead of those. But if you look at diversified financials in general, it's still got some room to go. So
I mean, as you mentioned Revolut before, I mean, that's almost a quasi sort of consultancy arrangement there too. So, it isn't the same company as it was 5 years ago.
Yeah, indeed. One thing I note in the results, the mention of the consumer duty, which is the FCA regulation, which came into force last year, which has caught out a variety of financial firms in recent months, in terms of the much greater onus the regulator is putting on companies to ensure they are doing right by their customers, etc. And it can interpret that in a number of different ways. I mean, CMC says the integration of these obligations within the group has proven effective, so you hope that would be the end of it. But there have been a few surprises in other areas, and it's worth keeping an eye on that, I think, in future too. But ultimately, it's very hard to predict the path of regulation, so a tough one for investors to...
Yeah, particularly in an election year too.
Well, indeed. On which note, we've come to the end. Next week, we will be on election day as we do the show, but I think it'll be our usual mix of companies and cover features and everything else we're writing about as usual. But that is the end of today's show. As I say, we've run out of time. Thank you very much to you, Mark, to you, Jemma, to Chris, and to our producer, Vic Thornton as well. We'll see you next week for another Companies and Markets show.